Have you ever noticed how the loan rates, mortgage interest rates, and savings account interest rates keep changing up and down? As of now, February 27, 2025, the 30-year mortgage interest rates fell to 6.76 percentage from all-time high of 7.2 percentage in May 2024. So what is causing all of this interest rate change? So it's important to understand that so that you can make a smarter financial decision. So before jumping into all of this, what is an interest rate? It's the money you pay for borrowing the money, or you get the reward for saving the money. And these interest rates are all around us. Whether you're buying the car or whether you're buying a house, you will be taking a loan and will be paying the interest for that. Or whether your savings in your savings account or credit card or high yield savings account, where nowadays you get a percentage anywhere from 3% to 4%. So the interest rates are all around us and we can't escape from that. So who decides this interest rate in US at least? The primary player in this game is the Fed, the Federal Reserve. They decide the interest rate in US and they keep changing up and down primarily to keep the economy stable. So why this needs to be kept up and down to keep the economy stable? So the economy is a cycle, right? There will be inflation and there will be recession and then again inflation and then recession. It's a cycle. And the Fed's goal is to avoid having too many cycles and they try to keep the economy stable. For example, in 2001, we had dot-com bubble and the economy shut down. And in 2008, there was a financial crisis and the whole housing market went down. So during these recession period, what did Fed do? They reduced the interest rate almost close to zero. When they reduce the interest rate, people borrow more money and they start to spend. And when they spend the more money, the economy starts to grow. And as the economy starts to grow, if it grows too fast, the inflation happens, right? So when it starts to grow, it stabilizes. But if it grows too fast, when the inflation happens, again, the Fed has to intervene. When the inflation is high, they have to increase the interest rate. So here is the opposite part. When the inflation is high, Fed increases the interest rate. And why do they increase the interest rate? Because they wanted to stabilize the increasing price. So when we increase the interest rate, people spend less. And then that will help to maintain or stabilize the economic growth. For example, you might have seen a latest example from 2020 to 2025. When the COVID happened, the economy shut down. And when the economy shut down, the businesses struggled. So in order to help and promote, the Fed has reduced the interest rate. And when they reduce the interest rate, right, so the people start to buy loan or borrow loan and money, and that helped to improve the economy in 2021 and 2022. So you might have refinanced your house or you bought a new house in 2020, 2021 with a low interest rate. But as you see in 2022, the price of things were much higher. Because the interest rates were lower, the price of the goods became much higher. And the housing prices in US, it peaked in 2022. And in order to control that, the Fed intervened in 2023 and they increased the interest rate. And when they increased the interest rate, either the economy starts to, or the prices starts to reduce, or at least it will stabilize. And as you can see in the housing market, the prices is kind of stabilized. But what is currently happening now? Currently, the inflation has cooled down a bit. So Fed is supposed to reduce the interest rates, but they may or may not reduce the interest rates drastically. What other factors would contribute to the interest rate? The global economic condition also contribute to the interest rate. For example, now President Trump has announced a tariff um, for imports from Mexico and Canada, 25% each, and additional 10% for China. So, which direction this can result in? It can go either way. When the tariffs are added, the price of the goods would increase. When the price of the goods would increase, the inflation will happen. And when the inflation happens, the Fed again can start to increase the interest rate. So there is a possibility that Fed can still increase the interest rate with the tariffs coming in. Or the reverse can happen too. Because of all this political tension, the economy can shut down or slow down. And when they slow down, in order to promote the economic growth, the Fed can reduce the interest rate. So 2025 year is a year to watch out and make the right decision. So you can even borrow money at a high interest rate. If you're buying a house, you can buy a house with a high interest rate, and eventually, in a couple of years, if recession occurs, the Fed may reduce the interest rate and you can refinance that. So make a smarter decision.